Hi, Nasdaq followers. I'm Danielle Rutsky, ETF Lead Product Manager here at MarketSite in Times Square with Howard Chan, the founder and CEO of Kurv Investment Management. What is the KQQQ in a nutshell?
KQQQ is an ETF made for investors who want to have a strategic exposure to the largest technology companies. We did our research and we found that these technology companies have extraordinary pricing advantage and oftentimes are dominant in their particular vertical. And in terms of returns, they've actually outperformed the larger broad market by an average of 5% over the last 5 years. And even if you go back 20 years, you've seen this divergence in performance, and that divergence has only gotten bigger.
What is the main difference between this product and other products associated with the Qs?
Yeah, KQQQ is a carefully designed strategy that looks at having an asymmetric upside and downside. So in the portfolio, we recognize that in this particular group, technologies goes through the cycles of exuberance and correction. And we take that as fact, as a quality of the particular sector. So when the market is going up, we weight certain names to magnify certain upside performance. And when the market corrects, we actually harvest volatility premia in the form of covered calls to generate income that mitigates a downside.
So how are these triggers happening? Is this an index fund?
No, it's an actively managed funds. We take 3 steps to construct the portfolio. The first is actually security selection. Oftentimes, the largest technology ETFs actually contains names that are not technology related, like Costco or Pepsi. We remove those, and then we take a look at the basket quarterly. For this particular sector, growth stocks generally exhibits momentum. And that just means that if the price is going up, it tends to go up until you have a pivot point. And when the market is going up, as I mentioned, we try to overweight the names that have momentum to give a different profile on the upside. And oftentimes when you reach that point and there's a pivot in the market corrects the exuberance, that's actually the perfect time to write cover calls. Volatility generally are higher in a market correction. That generates additional income, and that extra income streams mitigate the downside of the basket of technology names.
Why now for this ETF?
Well, I think it's very topical that the markets do have these cycle of exuberance and correction. The most recent cycle is during COVID, when everybody thought there were going to be homes forever, and then many technology stocks had increased in price because that was a means for them to shop or to enable work. But obviously, when news of COVID that we can actually see the sunlight again, there was a correction. So we realized this behavior is very endemic to technology stocks. And with the recent discussions about AI, we see another boom and correction. So accepting that condition, we wanted to design a strategy that can look to take advantage when prices are going up and somewhat protect and mitigate downside when the market is going down.
What allocation or role would this ETF then fit in an investor's portfolio?
Yeah, as I mentioned, we think this is a strategic exposure. Technology is in every part of our lives, not just the semiconductor or the software companies, but even companies like Netflix, which use technology that's changed its vertical. So having a strategic exposure in the portfolio is extremely important to have exposure to the growth part of the economy. And so we think this is a good complement or substitute to existing technology exposures or even large cap exposures in investors' portfolio.
Great. Any fun facts about Kurv?
Well, many of us have worked together for over 20 years. We were previously at PIMCO and Goldman, and one of the sayings that we have in the firm is never let a good market correction go to waste. So this is one of the inspirations for the product.
I think that's fantastic. It was great to learn more. Thank you so much.
Great. Thank you.